All right, everyone. Thank you for joining us here today. My name is Matthew Timpane. I am with Schaefer's Investment Research, and I am the senior market strategist over there. We have been in business now for 43 years, uh, maybe even 44 now, past July. But we've been doing options research since really options have come out. We're one of the longest firms in the market or in the industry, providing research to retail and institutional investors. So we really truly enjoy being able to help people trade the markets and learn option strategies. So today we're going to go over some option strategies for volatile markets. Just a little bit more background about me. I am a chartered market technician, so technical analysis is my go-to, but we do look at other things as well. So we'll get into that. Let me just probably get rid of this video of my face. If it's popping up on the presentation, I'm not 100% sure, but I'd rather just have you be able to take a look at the whole screen here. All right. So one of the things that we look at is we look at expectational analysis here. And it's really kind of just a Venn diagram, right? Everybody loves Venn diagrams. That was a big thing this past political season. But we look at fundamental, technical, and sentiment analysis. This was developed a long time ago by one of our founder, and it really just encompasses all forms of analysis to give us an edge. What we're looking at really is much more than from a fundamental perspective of price to earnings analysis, right? We're looking at could like this new product launch drive revenues? Is there something that's on the horizon from an event standpoint that could really kind of move the stock? We're not really looking at it from, oh, hey, price to earnings is cheap. I learned a long time ago when I was a portfolio manager for a registered investment advisory firm that looking at basic fundamentals and saying, hey, this is just cheap now is often a value trap. So there's some things I do like to look at, like price of sales, and other things, but really kind of it's looking at what can boost this revenue, what can keep growth in the company going forward. Technicals, obviously, we look at everything from moving averages to trend lines to support and resistance to Fibonacci's. I mean, you name it, we look at it. And then sentiment is a little bit different for us. We look at a lot of buy to open data within the options universe. So we're looking at what the speculative investors are doing within those options contracts. And then we're also kind of taking things from the option universe and creating things like a volatility scorecard where we're able to kind of see, hey, you know what, is this going to be a profitable trade? Or maybe this is better for premium selling because there isn't a lot of volatility priced into this. It's not, or there isn't a lot of volatility that's been actually succeeding at being successful that's priced into this. And we'll kind of go over some of that here. So let's move on to the next one. Just to kind of start it off here, since I don't know if I'll be back doing a presentation before or even around the new year, some things I like to kind of just touch on is mistakes that I see options traders make all the time. Front running your drivers is really kind of the one of the biggest ones here. Many traders are impatient and yearn for action, which really can lead to front running your drivers in general, right? So say you just see a pullback on a XYZ stock to $40, but you see it and you're like, you like it at 41.50 and you buy ahead of that support level that you may have identified correctly, but now you're only going to hurt yourself by creating a sloppy entry. For one, you're now battling time decay, theta as a test support. And if you're playing a short-term option, say weeklies, it's really going to hurt you, right? Because maybe implied volatilities didn't expand on that pullback. Maybe they just kind of remain, similar. And you're going to just really kind of take this big loss or, at least skate out with a lower win than you might expect on that entry, right? So even if it does bounce back, you're decreasing the leverage that you could have bought it at, and you're really kind of causing premature exits and losses on that instead of getting that leverage and getting the bigger wins. A lot of the times, entering just too early will also just cause you to get whipsawed. That's the whole point of saying the premature exits, right? You're entering in, and all of a sudden now you're down 50% on this option. It really could have worked really well if you just would have waited to 40 to buy it, and now you're sitting there going, well, I got to take this loss because I don't want to lose the other 50% of the premium I put out there. So front running your drivers is something I always see, and something I really kind of try to preach to, don't really want to be doing this. The only time I think it's even somewhat acceptable, and it's if you keep it on a tight leash, is if you see somebody buying or selling ahead of support resistance, maybe a big sweepers, right? Maybe they're playing for that breakout, but you now know you got some kind of fortitude behind it. You got big players looking at it, and maybe they know something that you don't know. That's really kind of what trading is all about, is trying to find an edge, trying to find what others do not know. Let your profits run and cut your losses. Simple. Stock traders can understand this as well as much as options traders. Really, you don't need to have a great win rate. You can take this formula, apply it to your own trading. As you can see, a 40% win rate with an 80% average win, and this is in options, minus the 60% loss rate, times a 35% average loss is still an 11% overall gain on your portfolio if that is how you're managing risk. It's a lot better than a 60% win rate and a 30% average win if you're cutting those winners short because you're like, oh, I don't want to give up these gains. And you hold on to those losses a lot longer than you should, and so you have a 40% loss rate, but it's 60%. Now you're down minus 6% on your portfolio. So you need to be able to just find it in you to hold on to those winners and then cut those losses at that lower level. The big thing is really what you're doing is you're killing, especially in the options market, the power of convexity, right? And convexity can run, and that's how you get these huge wins in options at time. And I'll kind of go a little bit more into that, saying, hey, a lot of times people play some more risky ones, but you can do it in a more conservative manner too. So just some other, things. Overcome your greed too. So now I say, hey, let it run, but also you need to overcome the greed. Sometimes you let things go a little bit too far. So really have target entry and exit points when you're entering. Look for risk reward ratios of 3-to-1, 4-to-1, 5-to-1, 6-to-1. And then once you hit that first target, I think it's a great point to just kind of take half off. If you're a newbie options trader, you might be taking a little bit less aggressive type of trade. So maybe 100%, right? It hits 100% on that option contract. Take half of it off. You think it still has more upside to 200%? That's great. But take half off. That way now you've protected yourself. Say something happens overnight, news comes out, that option contract goes to zero. The worst case scenario, you're at break even. And, yes, you're going to lose a little bit of the gain. And say it goes to 200%, you're only going to make now 150% on the total trade. But that's kind of the point of managing the risk in this. So worst case, usually for me, I told you the absolute worst usually is when the price gets back to the premium that you originally paid. So if you bought the contract for $5, you took half off at $10, and then it comes back to that $5 contract area, that premium that you paid originally. Usually it's a good time to sell. Just book that 50% gain. A lot of the times there's usually something wrong with the stock. It's usually broken some trend. You just want to get out of that then. Use price stops. Always honor your price stops. It's a good rule of thumb to never really let in options trading ever exceed 50%. Typically, they don't come back. They can, but they typically don't. I typically target somewhere between 30 and 50% losses, depending on the risk of the option and my upside target that I'm taking. So if I'm going to play a much more risky option, I'm going to be letting that thing go to 50%. If I'm going to be less aggressive and have built time into this, I'm buying 90 days out and in the money, it's probably going to be somewhere between that 30 and 40% range. Use time stops. Time stops are slightly underrated, I think. A typical good rule of thumb is half-life. Half-life is considered the day that you enter to the day of expiration. It's the middle part of that. If the option's not working by the half-life, maybe you still think it's going to work out, but at that point, maybe roll the option instead. So sell that contract, roll out to a further date, and buy that contract instead. Maybe it needs more time to work. Or if you're at a small loss, small gain, and you think, hey, maybe this isn't going to work, you just get out of it. That way you stop yourself from seeing a lot of theta decay, which I will show you a slide here, I think in the next 2 slides. What will happen to that time premium that you have built into that contract? And you just want to try to avoid that if you're not already in the money, and you're not in the money by a decent amount. Another thing here is misallocating too much capital to a position. All right, allocating too much capital to a position can have many problems. So we have this chart over at Schaefer's that shows the probability statistics of seeing X number of consecutive losing trades. But first, it is important to know that as an option buyer, you can only really, like I said, expect to be right about 35 to 45% of the time. As I showed in that previous slide, 40% win rate is, you can be very profitable. But, let's just kind of look at this. The best traders in the world, we know, average really win rate is about 50%. And I'm not talking about really investors that hold positions for multiple years. They can take some opportunity costs and hold on to those positions to make sure that they're getting 70, 80% win rates. Warren Buffett has a high win rate, but he holds for time. Traders that hold positions for a few months to a year or so, that's possible to have a higher win rate. But what makes these stock traders so good, though, is that they usually still cut their losses fairly quickly and let those winners run. They do, like I said, have a couple advantages. They can hold. They might give up the opportunity cost by doing this, but unlike an option buyer, theoretically, they do have an unlimited amount of time for this to work out. As an option buyer, you are defined by the expiration date only to that window of time that you have to be correct. So the option buyer also has to pay a time premium. And that's, again, we'll get into that with that theta decay here. So the more time premium that is embedded into that option price, it decays in like a non-linear fashion, and it's going to increase as we approach. So this means the rate of decay, is a headwind for us as option traders. So just knowing your probabilities and looking at this chart. So say you're 40% win rate percentage. That means you still have a 62.6% chance of seeing 6 losing trades in a row. That's a pretty good chance. I mean, that's more than a coin flip that you're going to see 6 losing trades in a row. And say maybe you're off on the year, you're only at about a 35% win rate. Obviously you're letting those winners run and cutting those losses, but that's a 77.1% chance that you're going to see 6 trades in a row lose. And you can, the data doesn't really lie. It happens. It happens to the best of us. It's happened to me. So you need to be able to think, hey, keep applying the same number of contracts to each trade or the same dollar amounts, right? The next trade does not have to be profitable, plain and simple. So never go, well, the next one has to be profitable, or even like us or some other person that's, you're getting services from. Well, they've been wrong 6 times in a row. I've seen their history. I know they're good traders. I'm going to go all in, or I'm going to put 50% now on this one because it's got to be right. It does not. Just keep discipline when trading. Buy the same position size or size accordingly. Do not think that the next trade has to be profitable so that you increase exposure that you're uncomfortable with. It does not work out well in the long run. I tell you, it is a fast way to a risk of ruin if you do that. So now here's the time decay chart that we've been talking about. And as you can see here, this is how time decay works for an at-the-money option as we head into expiration. And I do have a little question here. So thank you. I see someone, it's part of our services, so thank you. Repeat what you said in regards to the 35% and 6 trades. How about we just go back to that quick, right? So if your winning percentage and your trading options, right, is only 35%, so 35% of the trades that you are actually positive on, and then you're negative on 65% of the trades, the chance for you to have 6 losing trades in a row within a 50 trade period is 62.6%. So again, more than a coin flip. Really, close to 2/3 there. So a 2/3 chance almost of seeing 6 trades that just don't work out, which builds up frustration, right? None of us as traders want to be, seeing 6 losing trades or 7 losing trades or 8 losing trades. I mean, I've seen 10 losing trades in a row, and it's extremely frustrating, especially when you're like, God, I know what I'm doing. Uh, you know, it is the law of probabilities of that happening to you. So it doesn't matter if you're the best in the world. At some point, you're going to go on a streak, especially when trading options, where it's going to be a losing streak. But conversely, you're going to have the winning streak too, at times. So this is, again, just here's the time decay chart then. At the money, as you can see, it exponentially increases as you approach expiration. So this is just kind of a chart that shows you how that time premium starts falling off. So if you're new to options or have never traded options, you have a time premium component, which is called extrinsic value, and then you have an intrinsic value as well, which is what part of that contract is in the money, if any. So say you own the 50 call of, I don't know, Alcoa. I'm not sure where it's trading. It's probably trading under $50. But say Alcoa was trading at $55. You own that 50 contract, and that contract is currently trading at $7.50. $5 of that contract would be your intrinsic value. $2.50 of that contract would be your extrinsic value, your time premium. By the time it gets to expiration, if it still is trading at $55, it would just be $5. So this is how that works, for those of you that have never seen this before. All right. So mistake, buying the cheapest options. So I'm a big proponent of trading multiple styles. You'll see that, I even have a trade example where I'm trading 2 different styles, basically, that we're going to show here. But one thing that I see is an allocation factor where options traders allocate the same amount of money or percentage of money in their portfolio to options that have different risk reward characteristics. So let's just kind of go a little more in detail here. A lot of option buyers, and especially new option traders, will buy the cheapest options. Buying that 50-cent option versus that $5 option, people are just naturally programmed to buy cheap and try to sell high. But these options are usually far out of the money. Therefore, those options likely have anywhere from 85, 90 to 99% chance of expiring worthless. With these options, you can be right in the direction, but you still might not achieve your target price, and that can still expire worthless, and you might still see a 100% loss. So this is why I say allow to kind of allocate appropriately. I've got another question, so let's answer this question. I'd rather do that. If time allows, please repeat what price stop logic you run with. Okay, we could probably do that quickly at the end. Maybe I can pull up a chart too, and do that. All right. All right, back on to buying the cheapest options. All right, versus the, so just really have an understanding of what out of the money versus in the money is. Out of the money options gives you a higher profit potential, and we all like to say that we hit 700% or 1,000% type of gains. Those are extremely high risk. And really, you're most of the time you're going to be taking a lot of 100% losses or crap outs, is what we like to kind of call them. For the premium that you paid. I see people all the time, on X do the small account challenge and grow this tiny account from a small amount to, often 100,000 or more. And it really draws people in, especially people that are new to trading, because they're like, wow, I can maybe take like this $2,000-3,000 that I have and grow that. And you can, but what you don't know is a lot of times they do that small account challenge multiple times. They blow the account, but to them, losing $1,000 isn't a big deal. They likely already have a bigger account. They have likely done that small account before, and it's worked out for them where they've been able to grow accounts, and they trade a little bit differently in that bigger account now. So for them to lose 1,000, it's just really a challenge of trying to grow from 1,000 to 100 grand. You can really still achieve big hits too, with 50 deltas or 60 deltas. So you can buy at the money or slightly in the money and still achieve these huge wins. I remember when GameStop was, on the news and everyone was talking about, we actually had a trader on our desk. He was trading this in one of our kind of beginner programs. 60 delta, I think 60-day out, maybe even 90-day out contracts, a 60 delta contract, and he did it twice. I think one was 1,700 and one was 2,000% return on GameStop. You're just not going to see it as often, right? I can show you kind of one that we hit was really good, but it wasn't, it wasn't 1,700, it wasn't 2,000, but I'll show you kind of how that works in our trading examples here when we get to those. All right, so we got 35 minutes roughly left. Let's get moving a little bit. All right, allocate more to in-the-money options than out-the-money options. This is a great example of why. All right, so it also kind of shows you the power of options too. So you buy stock, 100 shares of a stock that's trading at 107. That's going to cost you $10,700. If you buy the short-term $100 strike in it, that's in the money. It could be $9 depending on the stock, and we're just using this as an example. And then if you buy two short-term at the money 107s, you're paying $550 for it, say. And at expiration, if it's break even, you don't lose anything on the stock. If you're trading in the money, you lose $200 or 22%, or you're losing 100% on that at the money option. Now, what's the difference here to me? The biggest difference here is capital outlay. If you're buying options, you're only using about 550 if you're playing at the money, or 900 if you're in the money on this position. And you're only risking $200 or $550. Now look at if it goes to $120 at expiration, it's $1,300. So 12% gain on the stock, $1,100, or 122% gain on $900, or 2,050 profit, or 270% there for at the money. And then you can see if it's at 105 at expiration. So, that's the power of options, and then that's the risk part, right? You're going to lose a little bit more, but the capital outlay is a lot smaller. So you can play more positions, you can do other things with that capital as well. And the only capital that's at risk is the capital you put forward. Say something happens to that stock that you just played, put $10,700 on, and it goes down to, $80 overnight. You would lose what? $2,700 there on the stock. You'd lose $900 on the option. You'd lose the $550 on the at-the-money options. So that's the difference there. You are protected from a risk of those types of events. So there is pros and there is cons when trading options, and you should understand that. All right, truncated risk. Major advantage of trading options is truncated risk, whereby you really limit your losses limited to that initial investment, as I've been talking about. Yet that profit is theoretically within the amount of time that your expiration is unlimited. Diversification also allows you to use truncated risk to its maximum advantage. We believe really in like a two-dimensional diversification system. The key really to achieving profits in options trading is to really kind of maximize your chances for very large percentage gains. This requires, both financial and emotional staying power, provided by two real trading rules here that helps you assure to be around to achieve those big profits. We know A, you don't want to lose all your capital. Can't trade, you can't stay in the game. B, there's an emotional toll on trading, and especially taking losses. We all know this. So to kind of reduce that risk and increase kind of profit maximizing technique with diversification, we really kind of like to look at it as trading some unrelated industries or sectors. As you know, trends can change quickly, and this will really kind of help eliminate any unforeseen events in one individual sector. Take healthcare, for example, recently. Healthcare, the election, everybody thought healthcare was like, hey, this is going to be good for the healthcare industry. And then, President Trump-elect appointed RFK, and you saw that XLV, XBI, all those that popped on the election news because they're thinking, okay, There might not be like big controls on pharmacy and things like that. Well, now you appointed somebody that wants to kind of revamp the healthcare system a lot. So whatever your take on it is politically, I don't care, but I'm saying that totally changed the outcome. And now you saw a bunch of healthcare stocks just get punished, right? So that's the reason why we want to do unrelated industries, right? Because something can come out of the woodwork. You know, semiconductors have been the trade for the last few years. What happens if that, President Trump-elect, when he gets in office, does something to that semiconductor bill that Biden pushed through? They're going to take a huge hit. And you're not going to know it's coming. It's just going to happen. So that's why you want to be in unrelated industries slash sectors. There's always a bull market somewhere within them, right? Energy has been honestly the best performing, sector during the Biden administration. Crazy enough, right? But it hasn't been performing good this past year. It's one of the worst. But even though this year there is still stocks in there that are performing really good, look at some nat gas companies, OKE for a ticker, TRGP. I've traded them personally, and they've been great. They're huge winners. TRGP is up like over 100%. And there's always going to be a winner, even in a bad industry sometimes. So you want to do unrelated industries. Secondly, you're going to want to do a mix of calls and puts. I know you're like, well, hey, the market's just ripping, but I will show you later on when we get to these ideas, which are just coming up, why you want to do a mix of calls and puts. It keeps you diversified for any kind of whipsaws that may happen. And there's always a bear market, always a bull market somewhere. I know that's the famous quote of Jim Cramer. There's always a bull market, but there really is. So you want to have that diversification. And then if the market turns as a whole, you have those puts, to save you from some of that call exposure. Obviously, you do want to make a ratio of this to what you're comfortable with. You think the market's going to go up, you're going to obviously want to be overweighted on the calls versus the puts. So whatever kind of ratio that you become comfortable with, you'll have to determine. It could be 2 to 1, it could be 3 to 1, but you want some of that exposure, and you'll see why. Because one put to 3 calls, that one put can make up for all the losses that you take on those calls. Even if they all went out 100%, maybe that put goes 300, 400%. This also will help reduce the fear mentally from seeing swings, especially in options trades of 20, 30, 40%. So this is definitely something that you want to implement when you're looking at trading options. And this will eliminate panic selling, right? Like, so you're not going to panic when you get those profits. You're not going to panic when you get those losses or gains. You're just going to be able to kind of keep going. I do got a message from one of our team members. Sorry about that. Yeah, so let's move on. Okay. All right, another mistake, poor option selection. We've kind of covered that, right? Short-term options versus, in the money options versus out of the money options. But this is just kind of looking at it from short-term versus long-term. When you're buying options, make sure that, hey, you're not using long-term drivers. Like, this thing can work out for the whole year. My top pick of the year for the money show was TSM. But the drivers for that was for a year long. And TSM has been great short-term. But if I would have just bought short-term options at a lot of periods of time, it would have been bad for TSM. So, I mean, looking at why you're trading this, if you think there's a runway path for growth there in a company, you might want to buy leaps, or you might want to buy 6 months out or 3 months out. You don't want to use the unwind of short-term option sentiment as your only driver for a long-term kind of catalyst. That may be an addition if you're buying longer term, but if you're just buying shorter term, you don't want to say, well, I think TSM is going to do well in the next 2 weeks because they have all these fab companies coming to them. There are companies coming to them to do fabrication on AI chips. It's not necessarily going to work out. You're going to want short-term drivers. Like, you're going to want to unwind of the put call open interest. You're going to want a breakout. You're going to want to have certain things there, right? So just make sure that the options that you're selecting align with your time horizon. And then focusing only on one time frame when looking at charts or stocks. It's a really bad idea. Review your charts from intraday to monthly time frames all the time. when in doubt, zoom out no matter what. Some of the best trades I've seen, you'll see a stock, it looks horrible on the daily chart. It's been in this bear trend on the daily, but it's approaching a long-term weekly, support zone that was previous resistance. And if you find the right setup there, a lot of times you can get some really nice short-term trades off of that because people are going to trade it. And maybe it doesn't work out, in the longer run, but you're still probably going to get that short-term reaction off that level because people have seen this level for years now. That hey, this weekly support, we're going to try to buy it there. Maybe it, like I said, doesn't work out for those longer-term traders, but in the short term, I guarantee you're going to see a lot of pops off those levels. Reacting to intraday noise, especially if you can't look at your screens. You see some news, really wait for that hype to come out of it. You're going to miss some trades that way, but a lot of the time you're going to get this pop in the price. You're going to get a pop in the implied volatility, and then it's going to come back, and then you're going to see a loss sitting there on your portfolio at the end of the day, going, "Why? What? What?" And it's because now they suck the implied volatility out of that option. Maybe it chopped around just, and now you're down 20-30% because the hype is gone out of that. And then trading illiquid options. If you see wide spreads, say $3.50 to $5, from the bid to the ask on a smaller stock like that, you're going to see that a little bit more as you get higher dollar, but you really want to keep that bid ask spread as small as possible. Less than $1 is definitely preferred. Really, if you can get it super liquid, you're going to be seeing 10-cent, 20-cent spreads. If you get into these ones that just have no open interest, and no volume coming into it, it's we like to call it a roach motel. They're going to let you in, but you're not going to get out that well. And both, you're going to get a sloppy entry, and you're going to get a real sloppy exit, because basically you're one of the only person with interest there, open interest there, and they're going to be able to do what they want. Why do I think the markets could get volatile? Well, after inauguration, we do typically see markets kind of stall out in a few months. After a rollout of new administration, seasonally, it's usually been about 3 months throughout time. It's been extended to about 6 months now in the modern era. But, as you can see here, this is from 1963 from the S&P 500 U.S. presidents that I have here. The bear markets have only come during Republicans in recent time. But I mean, let's just say if you actually look at the data, Republicans and Democrats have both had positive returns on average. So it's a little unfair to just say that, but in recent times, they've only come from Republicans. Some interesting stats all that I saw here: divided Congress returns, which been a lot of our elections, is only 4.6% the following year. Unified, though, for Republicans is 8.7% the following year and 11% for Democrats since 1920. So I think we're going to see volatility. That doesn't mean that the markets are going to go lower, but I do think we're going to start seeing some more volatility in the markets as we enter into 2025. Those that have traded when President Trump was before, you saw tape bombs. He'd tweet something, and all of a sudden markets will reverse huge. So it just kind of creates that. And, it can be a fun environment for some. It can be frustrating for others, right? Here's some presidential seasonality data here from our site. As you can see, 1 month returns 5.49% in 2020. 2016 was 4.5. And then you can see here the only years that were really bad 1 month after were 2008, 2000. 2012 wasn't great, but it wasn't horrible. It was down 1%. But most of the time, you have this positive tailwind into year end. The reason why I think volatility is going to pick up a little bit in 2025 is we're not really seeing inflation get killed like it was supposed to, right? Like we're supposed to be back at our inflation target date. And I mean, it's very simple analysis, but think about this. Look at 1950 and 1980. Chart just right now is going up and to the right. For a long time, we had this tailwind of inflation coming down. Now we're starting to get this up and to a right again. So either that gets corrected and we don't have bouts of inflation coming up, or I think, we're going to struggle with inflation a little bit. Fed's easing rates, and we're not even at our inflation target yet. There's many ways this could be resolved, recession, all kinds of things that could kill it. But for right now, it looks like the chart is from the left to the right is heading in an upper direction, We could get another bottom and another surge in inflation. I don't think they've really ruled that out, a second surge in inflation. I don't think anybody's really ruled that out because it does happen. And I just think that this could be something that would be, hey, we're going to have volatility. Markets typically don't perform great in this environment. If you go back to the 50s or the 70s, they were volatile. So that being said, I'm not bearish. This is a chart of IWM since 1950. 1950 IWM outperforms the S&P 500 by 3.34% to the S&P of was 2.58%. This was from the Stock Traders Almanac that just came out. Always great stuff in there. So small caps, and then that's also kind of a Trump trade, right? Small caps typically perform well following the last election for him. And then this data here, what was I talking about? On the Republicans and the Democrats, that came from Renmax. So I just want to give people credit where credit is due. All right, so as you can see, small caps, they're bottoming right where they should be. They're right at the July and August highs here, October highs. There's no reason to think, unless this breaks down, to think that this isn't probably a spot where bulls are going to try to step in on this chart. So you do have that 50-day exponential moving average rapidly approaching. Could we kind of hang out here for a while? I did write our Monday morning outlook this past week, and I said this week's really going to be about price discovery. It's going to be maybe choppy and volatile. So so far that's turned out to be kind of true. So we'll see. I think it is about price discovery and to find kind of a footing here. So maybe in store for that for a few more days. All right, Thanksgiving seasonality. This is done by Rocky, or quantitative analyst at the firm. So take a look here. Thanksgiving week, on average is very positive. Median return of 0.84%, positive, 70%. People are happy the holidays are here. He also breaks it down for you: Monday, Tuesday, Wednesday, and Friday. Leaves out Thursday, obviously. And you can see that all positive. Typically starts the week a little bit hotter, but we've seen some really good Fridays, Black Friday rallies. So don't think that the rally is just going to end Monday, Tuesday as we head into the holidays. But that's a good chance if we're coming into next the holiday week, and we're coming in near these support levels on the S&P 500 and the Russell. Good opportunity to maybe take some bullish positions. All right, here he breaks down option returns for Thanksgiving week. So he just did at the money options, closed at intrinsic value. So he's just looking at the SPY option, so it's just at the money. And this is the returns on those at the money options. So we have the call option return right there, and the put option return, and a straddle return. So kind of produces some volatility. Just going to put the offer out there. We'll have it at the end too, but in the money countdown is what we're offering today for anybody that wants to sign up. It's $795 for a lifetime subscription. You'll get it for the rest of your life as long as you live, and as long as we're all trading, right? This portfolio has more than doubled over the last 12 months. We're at 110% return over the 12-month rolling. This is a newer program too, but so you're kind of getting on the ground floor in the last 2 years here. But we give 6 put and call buy recommendations every month, targeting doubles or 150% on these in 5 days. Programs, what we're looking for is stocks that have a really low floor. So we're trying not to lose anything. We think, hey, this is going to be a solid support area. It at least isn't going to violate that, but we think this thing can attain 150%. If that's something you like, give us a call, text FGiven or to 513-675-0167. You can order through text. You can call us at 1-800-448-2080. But I'll put that up at the end too. The nature of volatility. All right, so volatility, just real quick because we want to get through all this. Volatility compression, obviously goes from compression to leads to expansion and vice versa. Think of impulses, goes into a consolidation that impulses again, coiled spring when you clamp down on that and you release and you get this propulsion move, right? Option prices are generally lowest during the consolidation phases. These are the times where you're trying to position into them before we get into like a big move. This is how implied volatility works. It's an old chart, but it does the purpose. It's old CELH chart. You can see here implied volatility increases into known events. Most of the time you got earnings events here, and you see how implied volatility goes in and then gets crushed after. So all that time premium that kind of gets, implied volatility just kills a lot of that time premium value after those events. So if you're not deep in the money, you're going to lose a lot quick. The only time it didn't really do it really well on this one looks like August, which I'm not sure. Still increased, but not great. Maybe there's a reason. But this is the IV term structure. This is looking out on volatility term structures. You should look at this when you're selecting options. 30, 60, 90, 120 days out. As you can see, some options are going to be priced, more expensive than others. A lot of times that's that near-term option that's near an event, as you can see here. So those are really expensive. But say you go up 30, 60 days, you're going to get an option that's much more relatively priced, better. So if you're bullish and you want to hold through that earnings, maybe that's the better way to go. This shows IV rank. This was back when Google was in a big downtrend. So this is an old chart, but you can see here, downtrends produced high implied volatility. And then usually bull trends are really ranked in the low end. So, as you can see below the 20th percentile, good opportunities to buy during bull trends. And then long-term or downtrends, you're going to see these implied volatilities really expensive. So that's the benefit. Option strategies for volatility: directional at the money, deep in the money, straddles, pair trades, credit and debit spreads. We have like 17 minutes, so let's get through these. I know there are some questions. All right, so directional at the money, as we talked about, that's about a 50 delta. You're buying, stocks trading at $80. You're buying it at the money. You're buying the 80 strike. Directional deep in the money. So in the money, I would say slight in the money is about 60 deltas. And then deep in the money is looking at like 70 or 80 deltas. So you'd be buying something that's, hey, stock's trading at $80, but you're going to buy like the 72 strike. So you got $8 of intrinsic value in there. Straddles is buying a call and a put at the same strike level, for those of you that don't know. Then pair trades is buying one security on a call and then another security for a put trade. And then we got credit and debit spreads, and I'll go over those. So when do we want to trade directional at the money? Strong directional conviction bull markets, when we're kind of getting those pullbacks, take those opportunities to take those directional trades. Beginning of a potential large pullback or even small pullback, because we think, hey, I showed you implied volatility expands in downturns, and that's an added benefit to buying puts when we think something's going to maybe pull back. Consolidation breakout. So stock's been trading sideways for 6 months and it finally breaks out. That's a great opportunity to look at directional at the monies. So you can get that, or you're expecting volatility expansion. Certain securities, like gold, for example, you'll find it in some stocks too. They like to actually, when implied volatility is expanding, they like to trade higher. They like to run. So, just going to take a look here at some of the trades. So directional at the money, right? Robinhood. This is a trade that we have done now multiple times. So the first trade we took here was Robinhood. It was on the breakout. We bought it the next day when it held this breakout level. Sorry about that. I ended up putting the breakout right there, indicator for entry. But the entry is actually on the long wick when it held the retest. We bought at the end of the day. And we saw a lot of things, right? It was up more than 100%, but analysts, were still very lukewarm on this. Our volatility scorecard was an 84. What was it that we saw? We were buying a breakout on the second day that produced 166% average daily volume. So people really wanted to get into this. Last 4 out of 5 times that actually happened, from that type of buying pressure, it produced follow-through rallies. And we got that follow-through rally. We actually came up to these to right here. And then we got the earnings report. So we actually were holding on to this. This was a December 25 call in Hood. And since our entry was optimal, we were able to hold through this, earnings reaction. We were down about 48% on it. This is my position, so I know how it went. And we were able, I gave it just barely any time. If it was gonna, honestly, if it went any more than it did, and it broke down, and it wasn't gonna hold this kind of like this 23, 22 level here, I was gonna get out. So it was kind of a luck on that it didn't roll lower, but as it started turning higher, we decided to stay in this. One of our traders actually put it on in an event trade where he traded the November the November standard November expiration, so that was 11/15, and then he exited somewhere his first half up here, and then he exited the second half last week, so for a 300% gain. Then I traded this in one of our short-term programs for a 5-day window. The trade went on not this past Friday, but the Friday before. So we bought right here. We had a 30 strike peak call. We broke through that 30 strike peak call. Monday, we opened up. It hit 300% on Monday. We closed the position. So that's the power of sometimes buying that. But I was still in that 25 call from December. So today we finally exited that 25 call strike call in Hood in December here at the IPO price around 38. We're trying to get out. Trying to get out for another 300% winner. I think really kind of ended up being about 270 some percent, because as soon as it touched this price and as soon as we were able to let subscribers know it, price just failed on us. But sometimes that happens, right? It's a big level, that former IPO price, very significant there for Hood. And here's another example. All right, so CLS, this was last month. I was playing same expiration week countdown we do. We're buying at the money options. I was buying the October 63 put right here at these arrows. We have 2 days of entry here, but you're able to, we're trading against these July highs. As you can see, they're failing against the July highs. And that's where the optimal entry was. We're risking 100% on this. This is a very aggressive trade, but I was trading for a 300% target on this. I believe this, both of these entries hit 300% by expiration. And just let me talk about why we kind of got in this trade. We saw that the call put volume ratio was 1.25. So there's a lot, and that was in the 89th percentile. So a lot of people were very call heavy in this as it was trading into these new highs. Options were surprisingly, decently cheap here. 28th percentile there. When we look at the IV rank, also there was stacked. There's a large 60 strike call level here, right? So somebody had bought a lot of 60 strike calls. Market makers are actually short those calls. So that's one reason why I was kind of using the logic of, hey, they don't want those calls to go in the money. We're going to trade against that. We're going to bet that the market maker is going to try to push this price down. And that's exactly what happened. So we're able to obtain that 300% winner on CLS. Directional in the money, we have strong directional conviction again. It's momentum driven. During pullbacks or early innings of a rally, and then protecting against volatility implosions, right? So this helps you protect against that high IV when you're buying, 70, 80 deltas. This is from the in the money countdown from this month. So you get actually a chart exactly like this, and you'll see I have technical observations up there. Completed the gap fill from the recent earnings report. It was pulling back to $170, which had been a prior resistance level. Came at the 20% year-to-date mark. There's a lot of these things lining up in confluence, as you'll see. The pullback was into the 50% fib from the July highs to the September lows. We saw puts building at the 170 and 165 strike. Earnings drift often turns positive after 3 days was data that I had. And then seasonally bullish first week of November, and we're buying an IV crush, so options were pretty cheap. Target 100%. And this was the optimal entry is between 168.50 and 173.50. This is where we entered right here on support. And then by the end of the week, you're trading up to about 182 there, kind of gave back into expiration. if somebody would have actually held on to this, I believe they hit 150% here on Thursday, but most of our subscribers were out Wednesday at that 100% because we gave our target. But that's the power of trading something in the money. This is something a little bit less aggressive. This is LYV, so Live Nation. This was in one of our programs. It's about 60 deltas that we buy typically in here. We bought this when it broke out of this resistance level. It was a concern that I was buying a little high. I wasn't buying fully back here, but it's a trade comes out on Mondays, and we kind of look at them at the end of the week. But they're longer term view. It was December 110 call. Short interest was 8.36, and it potentially peaked. And we saw that it rolling over. So shorts were really covering here. When we're looking at like an open interest ratio, put call ratio, we call it a SWOR, is in the 97th percentile, and is actually rolling over from an all-time high level. A lot of times when we see that happen, we saw these melt up rallies in this. So, and options were trading only in the 9th percentile. So a lot of things were lining up for this. Arguably, given it was a bit stretched, but this 10-day was holding really well. We traded it, and on election day, we got the boom from it. Got us out. Everybody got out about 128% for our subscribers. Straddles. This is the profit from volatility, anticipating a large move on the horizon, underpriced relative to a potential move, call and put, same security, and expiration. All right, so we were playing the AZN. You'll see here the green. This is buying. Our trader was buying the 81 strike for August 30th. And as you can see, he was buying the breakout, but he didn't know if it gave it back, it could get volatile. As you can see here, big level. Got volatile recently and fell down and pushed lower. So we're playing this, and he was able to exit right at expiration for about 78%. This is a way to play those extended moves. You could have arguably entered another straddle up here. It's a good way to play momentum and in extended moves that maybe you're afraid of giving back, so that you're able to kind of still either capture the momentum to the upside, or you catch that high tight flag that fails on you, right? So, a lot of times you'll get that they implode and the puts would have paid. Now you're not going to get 200-300% gains. You're going to get 70s and 80s and maybe 100s and 50% gains because you're playing both sides. But it's a way to play momentum in volatile markets. And in my opinion, it's best to play either on that contraction break or when you're up at a peak like that. Because it can keep you in that momentum trade going higher, or it can be a nice hedge to go lower. Uncertain market direction for pairs allows you to profit from volatility, call, put, bullish, bearish, outperformer versus underperformer. Two classic examples here. We might not get to some of the stuff because it does look I'm getting really close here, but this was IBM 195 call. We entered it on 8/19 August 19th here. Beautiful base. Trader was playing it ahead of the breakout though. One reason for the pair trade, but as you can see, we exited over here, and that was up, I believe it was like 224% on that call option. He did exit early just because there wasn't a lot of delta left in that contract, but he was also paired, and your risk is the pair goes against you. So they were able to get about 100% here. This was CDW, and they bought the 220s in this. You see the red arrow here. They bought it here. They sold it here. So it went sideways, lost value. I think it was down like 10% or something. Credit spreads, directional bias, great for beginners. You can profit from a wide range of outcomes, up, sideways, slightly down. You have cap losses, and you're using time decay as your friend, because as time decay falls, your options are getting profitable. So here's TSM. I traded this October 17th at the green arrow here on the breakout. As you can see, we sold it here on the breakdown. It could not regain it in the final week. This was expiration. We filled for 65 cents and we sold for around 24 cents. So we were able to pocket about 20 or 2/3 of that premium. And you can see the stock actually broke down, broke through support. Still a profitable trade. And then here's another one here, Uber. I traded this on the breakout. Came back down through, but I was able to hold because it was a credit spread and it hadn't violated my rules of double the premium, and we're still holding the 50-day. And then I was able to exit this on that move up for about 1 or 2 pennies on that big move from, I believe it was the Tesla move. Vertical call debit spreads. This is a way to take kind of directional bets with less upfront capital. You're going to sell a higher strike call and buy a lower strike. High probability of profit, lower break-even level. Time decay is more muted. This is one that we recently did. It was IONQ. The entry was on 10/18. And then we did take profits twice here. We took profits right around earnings and then the day after reaction here. I believe that was 225%. I don't trade the service, but as you can see, we broke through these kind of base levels here. This was a second base level, and we knew, hey, you have some 1550 potential resistance. Next level is really 1660. That's why we took the profit there, and then it pushed right through the next levels at 20 bucks. So thank you for everything. I'm going to see if I can get to these questions real quick. I know we got 3 minutes left, so let me just look. PDF download format slides are available for all webinars. Yes. I believe we can get those over. If you just contact us, we can always get those over to you, or contact Dave at Timing Research, and we'll figure out a way to get that. And then, yeah, okay, so price stop logic. So looking at a price stop when trading options, my logic is this. If I'm trading something like a 60 delta that's slightly in the money, or 70 or 80 delta, I'm going to look at 30 to 40% as my kind of stop loss on the price stop on that option contract. I want to have that align up with the chart though. That's the big thing is you want to be able to make sure that that loss will align with your chart and where you think the appropriate level of violation of maybe a support resistance level or moving average that you're looking at is in confluence with that. And then if you're trading more aggressively at the money, you want to let that loss get a little bit bigger. It's going to move around a lot more. That's my logic in that. You can see a minus 50% bounce back when it's at the money. Happens all the time. But that's about my line in the sand, is right around minus 50%. If I don't like the way price is maybe acting in that stock or something, I might cut it, somewhere between 45 and 50. But you want to be able to let that go. In like the countdowns, we're looking at 100%, but that's why we're targeting 100% losses on some of them, especially in our weekly. It's the first month or first week of the month, and then our expiration week when we're only doing 5-day trades. We're looking at 100% loss on those, but we're targeting 2, 3, or even 400% on those trades. And as you can see, when I talked about risk reward, you want 3-to-1, 4-to-1, 5-to-1, 6-to-1. You're getting that just based on those targets from the option contract. If you're going to risk 100%, you're going to want, maybe a 300% gain. We do have about 1 minute left, so if anybody else had any questions, I could answer real quick, but if not, I think they need to take it back over for the next person and get prepared. Again, thank you to everyone for coming out. Hopefully I didn't talk too fast. Hopefully I got through everything that you wanted to see, and give us a call. We'd love to trade alongside you. We have a lot of free stuff even on the site. As you can see, I put a lot of that stuff that I was putting up on Seasonality, that's all free on our website. We have articles that go out every day. Come check us out. I mean, there's even free ideas for trading ideas all the time that we put, like, seasonal data, or this, stock reacts to the 20-day moving average. This is what we've seen in the last 10 signals. So we give you quantitative data all the time, just in some of our media. So again, thank you, everyone. Have a great Thanksgiving.